Dividend investing appeals to many kinds of investors. The top dividend stocks offer substantial dividends that also increase gradually. Given ongoing concerns about inflation among investors, now could be an especially opportune time for dividend investing. But how can you maximize the benefits of dividend stocks? Top investors employ various strategies to optimize their returns. Here are some key secrets to successful dividend stock investing. And stick around until the end of the video. I'll give you the best dividend stocks for dependable dividend growth. I have 5 tips to share with you about what to do and what to avoid. Because when it comes to dividend investing, avoiding foolish decisions is just as crucial as making wise ones. Tip number 1. Look for sustainable dividends. Legendary investor Warren Buffett has said that the number 1 way to avoid loss is to find sustainable dividend. When investing for dividend, it's important to choose companies that can maintain their payouts even during temporary business downturns. A sustainable dividend is crucial for investments, as an unsustainable dividend can lead to a decrease in stock price and investor confidence. If investors anticipate a dividend cut and it actually occurs, they may sell their positions, causing further decline in the stock price. A simple method to gauge the sustainability of a dividend is to assess the percentage of the company's profits allocated for dividend payouts. Companies distributing less than 50% of their profits as dividend are generally better equipped to endure business downturns without resorting to cuts. However, it's worth noting that certain entities like REITs can comfortably distribute higher cash flows without encountering significant difficulties. Tip number 2. Reinvest your dividend. Receiving cash dividends from your stocks is valuable, but spending that cash means missing out on the compounding effect of reinvesting dividend. Reinvesting dividend can provide a significant boost to your portfolio and accelerate your investment gains. To highlight the importance of dividends reinvestment, especially during periods of slow market downturns, think about this. Over 40% of the S&P 500 returns since the 1930s can be credited to dividend income. Dividend income tend to mitigate the impact of stock price volatility overall in a portfolio by cushioning price swings. Many brokerages would automatically reinvest your dividend at your request and will even buy fractional shares, so all of your money is put to work right away. Subsequently, you make even more when the next dividend is distributed. Ideally, this establishes a positive cycle where your wealth compounds with each distribution and reinvestment cycle. Dividends are subject to taxation, even if you choose to reinvest them. Therefore, dividend reinvestment may be most advantageous within tax-advantaged accounts like an IRA or a 401k. Within these accounts, taxes may be deferred or potentially avoided, especially with the Roth versions. Tip number 3. Stay clear of the highest yields. When scanning through lists of the market's top yielding dividend stocks, you might be tempted to go for those with the highest dividends. It may seem like the fastest route to growing your investments. However, high yields often come with risks. This signals a lack of confidence in the sustainability of the dividend, prompting the market to lower the stock price accordingly. Buying stocks with the highest yields can be harmful, as often these high yields are temporary and may consist of one-time distributions that artificially inflate the yield temporarily. Securities like these typically experience significant price volatility. If you're the average investor, it's advisable to stay clear of the stocks with the highest yields. Investing in these high-yield options could lead to significant losses, outweighing any gains from the appealing but deceptive 7 to 8% yield. Tip 4. Seek out dividend growth. Keep this rule in mind. Dividend growth is of greater significance than dividend yield. A common pitfall to look for is focusing solely on a stock's current high yields without assessing its potential for future payout growth. However, a steadily increasing payout can serve as a buffer against rising expenses in your portfolio, which is especially important for long-term investors. Many people focus exclusively on a stock's present high yield and neglect to assess the potential for growth in distributions over time. If you plan on investing for the long haul, growth in payout will help you offset the impact of rising costs on your portfolio. Generating robust and sustainable free cash flow from operations enhances the probability of a company expanding its dividend and delivering solid returns to shareholders in the long run. You can conduct several checks on any company to assess its potential future dividend growth. Here are 3 of the most common ones. There is the dividend payout ratio. This is the fraction of income paid to stockholders' dividend. A lower ratio indicates a company has more room to safely increase its dividend. Then there is the dividend growth rate. This measures how quickly a company has increased its dividend in the past. A higher growth suggests management is inclined to approve larger payouts. And third, the earnings growth rate directly influences dividend growth potential. A company with consistent earnings growth can likely sustainably increase its dividend at a similar rate. For instance, if earnings grew at 10% annually, the dividend could feasibly grow at the same rate. Tip number 5, buy and keep for the long haul. If you're serious about transforming your portfolio into a dividend powerhouse, you will need to focus on long-term investment. This involves identifying reliable dividend-paying stocks and holding on to them over time, even in times when you are faced with negative news. Just so you understand and appreciate the power of buying and holding for the long run, consider this. 30 years ago, Warren Buffett's Berkshire Hathaway company bought 400 million shares of Coca-Cola for $1.3 billion. The stock is now worth about $23.8 billion, and Buffett earns significant dividend from this investment. Take a look at what Buffett earns in dividend. Coca-Cola's current dividend yield is around 3.22%, which isn't particularly high, but Berkshire Hathaway earned over $700 million in 2023 from its investments. This is enormous. Such is the power of dividend investing when you employ a buy and hold approach. It pays to be patient. So what is the best dividend stock for dependable dividend growth? If you're interested in adding reliable dividend growth stocks to your portfolio, consider the S&P 500 Dividend Aristocrats. This index comprises 66 companies from the S&P 500 that have consistently increased their dividend annually for at least 25 years. While these companies operate in various sectors, they all share a commitment to steady and sustained dividend growth. Many people believe dividend investing is only for conservative and old investors, but it can actually be one of the most reliable and profitable ways of investing. Follow these 5 secrets to improve your dividend investing approach and always keep a long-term perspective. Go ahead, leave us feedback and share your thoughts in the comments. And if you found this information helpful, smash the like button, subscribe to the channel, and share the video with someone who could benefit from it. Until next time, stay financially savvy. We'll see you in the next video.